Hello everyone. This time we are here to discuss a brief note about what went wrong with Lakshmi Vilas Bank. A well-known bank, 94-year-old bank based out of Karur, Tamil Nadu, doing very well there in the state, having spread its wings all across the country, having acquired 8-10 smaller banks in its heydays, suddenly had to go down under. For us to understand what went wrong with Lakshmi Vilas Bank and therefore what could be the learnings for us as a country, as an economy, as a society, let us spend some time trying to understand what is a banking business, how is it different from any other regular business. If you take a business of a manufacturing, let's say a pen manufacturing or a phone manufacturing, you have some amount of raw materials that you purchase, you put it through a production process or a value addition process. Finally, you take the end product to the market and sell it at a decent profit. If in case, for whatever reason, you are not able to get a good price, which means to say you are incurring some loss, and if the loss sustains itself for a longer period of time, the organization becomes bankrupt and therefore it closes, sick and closes. How does it work in a banking situation? What is the raw material? How does the bank work? This is something let's spend a few minutes on. Bank primarily is a middleman between two sets of players. One, people who are interested to put their money, park their money as deposits, and another set of people who are interested in taking money as loans, which means there are a lot of people who have a need to park their extra money, the surplus money, for a wide variety of time. It could be, let's say, 3 months, 6 months, 1 year, 5 years, and the amount could be varying. It could be 100 rupees, 10,000 rupees, or probably a couple of lakhs. The same thing is applicable in the case of the borrowers. They might need it for a 3-month working capital loan, or a 3-year car loan, or a 10-year housing loan, or probably a big term, long term loan for an industry, right? So what the bank does is, using some amount of statistical modeling, basis which the banking industry runs, takes money from the depositors, understands who the good borrowers are, lends it to them, and manages the requirement of both the sellers and the buyers. And by doing so, it manages the additional source of income for itself, which is in the form of a net interest margin. Let's say you give the depositors 5% of interest and you charge 10% interest from the borrowers. The difference between the 10 and 5, which is another 5%, becomes your income, right? This is a broad look into how the banking industry works. Given that the banks directly deal with money, other people's money, the banking industry is heavily regulated. The RBI in India tends to put a good amount of regulations to ensure that the other people's money are safe with the bank in terms of their security, in terms of how it is given to others as loans and recovered, and therefore being in a financially viable situation. The first and foremost is the banking model runs on two key ratios. One is the CRR, the cash reserve ratio, and the second is a SLR, statutory liquidity ratio. What it means is, for every 100 rupee deposit that you get, you put 10 rupees outright. Let's say CRR is 10%, you put that 10% directly with the RBI, so that you are left with only the remaining 90% to lend. Even in the 90%, you can't lend everything. Let's say there is a 30% SLR, which means you must have some of your assets in such a way that it's easily convertible into cash and returned to the depositors if the need be, right? So this could be gold, this could be government securities, so on and so forth. So what happens is, finally you are left with, out of 100 rupees, CRR plus SLR would become 40%, the remaining 60% is what you are left to lend. If you can't lend the entire 60%, then obviously some amount of asset is left unused and therefore the income is lost. At the same time, if you are lending some amount of money, it could be the entire 60% or a part of it, but if that loan goes bad, it becomes an NPA. In which case what happens is, you are not only losing the income coming out of it, but it's going to hit you at your net worth itself, because while the borrower doesn't give back your money, you are expected to return the money to the borrowers, because the agreement is between you and the depositors and not between the borrowers and the depositors. Therefore, the bank needs to be extremely cautious and careful while giving out the loans. Lakshmi Vilas Bank indeed was a well-known bank, doing decently well. What went wrong was at two levels. One, the unbridled need for aggression, moving away from small businesses let's say you are having about 700 crores. Either you can give it to 700 different people 1 crores each, or you can probably give it to 1 or 2 people at a 300 crore plus, or probably a 700 crores to one person. While the administrative expenses would be extremely low if you give it to only one person, the problem is if that loan goes bad, it becomes NPA, your entire bank goes for a toss as far as your big asset is concerned. That's exactly what happened, unfortunately, with Lakshmi Vilas Bank. There were two things. One, the bank's intent to go aggressively chasing big ticket loans, coupled with lack of corporate governance, good practices, led to this situation. The two brothers, Malvinder and Shivinder Singh, known for their not so ethical and not so good corporate governance background, having done scam in their own company along with the companies that had acquired their companies, had a banking relationship with Lakshmi Vilas Bank. There they tried to sort of outsmart the bank by conniving with a couple of employees and officers of Lakshmi Vilas Bank. What happened was, Religare, which was a unit of the company run by the two brothers, had put about 700 crore plus as their fixed deposit, and that fixed deposit was supposed to be free and without any encumbrance, which means it could not be kept as lien for any other loan to any other person or to any other unit of the same group. What the two brothers in connivance with the banking officials did was use that in a wrong, unethical way as a security to take about 700 plus crores loans for their own private entity. Had the loans been returned and come back, very unlikely that the situation would have arisen. But what happened was the loan didn't come back, which means to say the bank was left with no option but it had to liquefy the FDs so as to make good its losses. That's exactly what the bank did. But little did it know that the Religare unit, which had initially kept the deposit, would raise an objection saying that this was never authorized. The very fact that it was an unauthorized transaction made the depositor go to the court, and the court, in its wisdom, put a stop to the bank taking this amount, squaring it off with respect to the lost loan. So the bank was in a very, very unenviable situation. It had given money in a wrong way to a person who didn't return the money, and therefore the supposed security couldn't be used as well due to the regulations put by the court, and it was left short of 700 crore plus at one go. This was a major blow. It was a big hit to the bank that it could not sort of recover from. It went short on its net worth, it went short on its profitability, and therefore it was capital starved. Given the Basel norms, it had no other option but to sort of scout for capital so as to shore up the capital adequacy ratios. There was a situation wherein it was about to sort of get merged with the India Bulls, but unfortunately the RBI didn't approve it for the reasons in terms of the long-term depositors' interest. There were two more other situations that came up for acquisition, but unfortunately they too didn't go through. It led to a situation wherein finally the bank started becoming sick by the day. Just to sort of give the numbers, the gross NPA of the bank by around 2018 was 10%. Though it was on the higher side, it was way under control. But if you start looking at the way it ballooned, in 2019 it became 15.5%, and by 2020 it became 25.5%, which means to say each passing year, instead of controlling the NPAs, the bank was losing more money, it was eroding its profitability, it was eroding its net worth. What was the final outcome? The market started seeing where the bank was heading towards, down south, right? So 185 rupees was its price of the share in 2017 at its peak, and by 2020 it had fallen down to a very, very meager 10 rupees. So the writing on the wall was very clear. There was an issue with respect to the bank's corporate governance. There was a problem in terms of its own internal processes and governance, and there were very few people who were willing to join their hands as a white knight to save the bank. In this situation, the shareholders of the bank rose in a sort of revolt and removed 7 directors, including the CEO, and the RBI in its place put few of its own officials to run the bank. But even that wasn't sufficient enough to sort of turn around the bank, and finally in this November 2020, it's a very unfortunate, ironical situation. It was in the month of November when the bank started that it got its license and started its banking operations 94 years ago, and in the same month of November in 2020, it was being led to be acquired by yet another bank. Here one must really appreciate what the RBI did. It moved into a very swift action. It got another bank which was operating in India with very, very strong financial conditions to acquire this bank, so that the interest of the depositors, most important, was protected. It could be a case wherein you are looking at only Indian banks acquiring other banks, but the RBI's thinking was very clear and loud that any solid bank operating in India will have the opportunity to be acquiring such similar banks in these situations. The learning for all of us, and especially the other banks in this situation, is simple, very clear. Bank runs on trusts, and trust is the biggest asset that you have when you are running your business and you are growing. Therefore, to retain this trust, your ability to sort of control the NPAs, control the bad loans, most importantly control the bad behavior of operational risk, either of your employees, your borrowers, or a combination of both, is extremely important. Therefore, having good corporate governance practices and ethical conduct in the bank is the biggest asset, apart from your technology, apart from your skilled manpower, so on and so forth, that will ensure that the bank not only grows, but grows in the eyes of the depositors with full trust and credit worthiness. In as much as the credit worthiness of an individual borrower is important, the trustability of the bank is more important. This should be the biggest takeaway for all of us who are looking at the debacle of Lakshmi Vilas Bank. Thank you.